Moving on to another stock then that's in the spotlight on the back of numbers, Persistent Systems, and that's uh, continuing to remain rather range-bound in trade. Let's connect with Sandeep Kalra, who is the Executive Director and CEO at Persistent Systems, because it has been quite a steady quarter. Thanks much for taking time out. A growth rate which is slow to about 5.8% after 5 quarters of 9% plus growth. That's largely on account of the higher base. Going forward, do you think that this 5 to 6% QOQ growth is what we can expect?
We are happy to report the last quarter was another solid growth quarter for us across all major business metrics, revenue to profitability, all these metrics. The revenue for Q2 came in at $255.56 million. This gives us a 5.8% Q on Q growth on dollar term basis, 40.2% year on year basis. In constant currency basis, this is 6.6% Q on Q. Keep in mind, this is on the back of 5 sequential quarters of 9% plus dollar growth for the last sequential 5 quarters. Now, if we look forward, we have done a pretty good order book. Our order book stands very well from a TCV, ACV perspective. We've booked roughly about $1.45 billion in a TCV perspective, trailing 12 months, and about $1.1 billion roughly on a trailing 12-month ACV perspective. This should hold us in good stead as we go ahead and should help us deliver industry-leading growth in the macroeconomic environments, which may be changing on us and which are hard to predict.
Mr. Kalra, since you brought up TCV and ACV yourself, if you would permit me, TCV deal win, if I look at it slightly soft, you're seeing approximately a 15% drop in renewals. Also, like you were talking of the numbers, ACV has been healthy. Going forward, for the fact that TCV has been soft, how are you going to turn that around? What's the expectations? Any outlook you can give us?
The TCV and ACV are always dependent on the order books that you have in that particular quarter. Now, if you trail back a few quarters, we have trended very well, whether it is ACV or TCV. And for a company that has declared $255.6 million in revenue terms, if we do $271 million in ACV and we do $368 million in TCV, it's a fairly healthy, TCV and ACV from a growth forward-looking perspective. So we are pretty reasonably happy with where we are, and some quarters may be higher than this, and some quarters may be reasonably lower as well. But overall, if you look at trailing 12 months, as I said before, we are at about roughly $1.45 billion from a trailing 12 TCV perspective, and about $1.1 billion from a ACV perspective. So all good and healthy, order books.
Sandeep, hi, good morning. This is Anisha also joining in. I know your exposure to Europe is limited to below 10%, but if you look at the growth rate this quarter, it was much below the company average because the Europe business grew by just around, 3.3% sequentially. What's the situation like in Europe, and are you expecting a further slowdown there?
Right. So if you look at Europe, Europe traditionally has been a much smaller portion of our revenues. But for the war in Ukraine and Russia, we would have focused more on this geography. As of this point in time, if you look at the geography, there are significant challenges because of inflation, because of gas-related, issues owing to the war and so on. So within that, if we are able to grow, and one of the largest deals that we did in this quarter gone by, which is roughly about 80 million in TCV terms, came from the European geography. So we are reasonably well poised given the macroeconomics and environment and the challenges that we see in that geography. So we are happy where we are and the growth we are getting, and we'll accelerate it over a period of time.
Mr. Kalra, for the quarter that's gone by and that we're reviewing right now, what we've also seen at Havells is salary hikes. I think what we would also want to understand is that how have you reported this EBIT margin at 14.6%, which is even higher quarter on quarter. So it's gone up quarter on quarter by what? 27 basis points. Markets was expecting a decline. So you surprised the market. How?
Right. So if you look at our, company-specific financials, our salary hike was effective July. This impacted the financials by about 230 basis points. This was largely compensated by the higher IP revenue that we had. It helped us by about 80 basis points, favorable currency, another 90 basis points, margin from higher services revenues, and so on. So we were able to healthily negate the impact of pay hikes. So if you look forward, even from a forward-looking perspective, the pay hike is already absorbed. Attrition is stabilizing. Hence, its impact on wage bill should moderate as we go along. We have inducted a lot of freshers over the next 2, 3, 4 quarters, as they become billable, that's another margin protection for us. And our utilization could always be a little better. So from that perspective, we are fairly well poised at where we are. And we have said before as well, our endeavor would be to deliver margins equal to the last year or better. So we are well poised from there, and there are enough levers for us to protect the margins.
All right. Thank you so much for walking us through the outlook on Persistent, giving us a sense as to how you're seeing your geographical growth as well as what the expectation is when it comes to your overall numbers.